All right, so real quick, I just wanted to thank everybody for attending, and also thank George for making the long trek all the way over from Boston for us. So he's going to go over some kind of key things to know about, particularly when you're looking at budgeting for an SBIR or an STTR. How do you set up your accounts? What's kind of important? Essentially, how do you keep yourself from getting in trouble with someone like DCAA when they come in at your phase 2 and say, okay, well, let's give you an audit. And then you go, oh, wait, what do you mean? So George's going to give you a lot of information here. I believe the format is going to be about a 45-minute to an hour presentation, and that'll leave about 30 to 45 minutes for questions on Q&A. If you actually want to sit down and talk with George, there will be that opportunity. And then we're going to have an informal kind of a networking event at Dialogue Brewing at 6:30 just kind of for our Innovation Summit that is actually tomorrow, but then also it's a great way to meet with some federal program managers because there will be program managers from the Navy, Air Force, and NASA that will actually be there. So you can talk about what you're doing, what you're working on, if it's actually a fit for what they're looking for within their organizations. And it's a great way to actually get some sort of idea validation. But I turn over the floor to you, George. I'll be right back.
Thank you. All right, let's see what time. It is evening, right? Yes, okay. So good evening, everybody. Thank you very much for being here. My name is George Moker, and I am Managing Director of Ambrosi Donahue Congdon, a CPA firm up in Newburyport, Massachusetts, on the border of New Hampshire and Massachusetts, so a little north of Boston. And today we're going to talk about really basics on government contracting. So I'll try to make it as exciting as possible. We are talking about accounting, but as you can see, my background, I'm a CPA, but I have a doctorate in education and creative innovation. So I bring the creative side into the accounting side, which I think might be illegal. But outside of that, though, I'll try to bring as much of this as I possibly can to help just give an introduction of what the basics are in doing business with the government, what the accounting side looks like, how basic things really are. It's easier than what it sounds like, and in the end, whatever the government asks you to do is best practices. I'm the director of the Center for Entrepreneurship at Suffolk University in Boston. Been doing that for the past 14 years, and I'm also an instructor in teaching entrepreneurship courses at the university. I'm full-time faculty there. So I'm hopefully going to bring a bunch of entrepreneurial things into play also. If we think about commercialization, what does your company look like going forward? Even though you might be at the very beginning stages, I always think of planning your business where you want to be. And then everything you do, get yourself to that goal as opposed to react to what's in front of you today. So the basics today are around what are the various components of a proposal when you put a proposal together. I'll try to touch on the numerous agencies as I go through this because some of you will be from different agencies. My background is in DoD, it is in NSF, NIH. We have grants from most of the awarding federal agencies. And when I first got started in this space, I was a controller and eventually a CFO for a government-funded research firm that did work with NASA and the Air Force. So I was inside the organization. Then the contract got terminated at the convenience of the government. I learned how complicated government contracting was and said there's got to be a better way to do this. So I founded my own firm in 2002, focusing on government contract consulting for companies that were trying to build accounting systems, be successful in audits, pre-award surveys, indirect rate management, indirect rate formulation, and so forth. And then since that time, I've sold that firm to Ambrosi Donahue Congdon, where I am today. So I'm going to share all of that with you as far as the various elements of how you put a proposal together. And we really have, when you're doing a proposal, we have direct costs, indirect costs, we have profit, and then at the end, we'll talk about what it looks like in some kind of action. And if you sign in, we'll be able to get you some of the templates that you can go ahead and use. So with the government, all of you may have either seen this or you're going to see this where you're putting a proposal together. It all starts with there's some type of request for proposal or a solicitation around whatever the concept is or topic is that the federal government wants, depending on their agencies. and then you align that with what your interests are, and you come up with the certain things that you want to apply to. And from that point, you're putting together this proposal. So the technical side becomes very, very easy. The science side is the easy part of all this. And from my standpoint, the budget side is definitely the easiest part of all this because I'm not a scientist. And what ends up happening is there's a lot of shortcuts that are in the marketplace that say if you're trying to do a phase 1 proposal or a phase 2 proposal, then go ahead and use a backwards approach. And this backwards approach means that you start off with whatever the award amount is going to be. So let's say $225,000 for an SBIR phase 1. You divide that by 1.07, which is your fixed fee percentage, and that's what you have left for your direct and indirect costs. Usually what happens is any type of applicant that we've seen has a really strong knowledge of the individuals and consultants who are going to help them with the research. They know the types of materials they may need. They know the direct components. Subcontracting is a little squishier, a little harder to nail down in the proposal process, but a very good sense on the direct side. And then what happens is we plug the indirect costs. So whatever is left, $225 minus my profit of roughly $15,000, leaves me $210,000 for direct. If my direct costs are coming out to be $150,000, my indirects are going to be $60,000. That's plugging into the number in the end. It's a nice shortcut when you're doing a proposal at 11:59 right before the filing deadline or submission deadline. It's a really bad approach when it comes down to now you're going to get the award and the government's now looking through some of your costs. So what we recommend, and every agency is a little different, but we recommend is that you look at what is my total direct cost that it's going to cost me to do my research on this proposal, and that should be the same as the backward approach. We call it more of a top-down approach. The second part is what are my actual indirect costs going to be? You can actually predict these things. And then I know what I want for my 7% profit or my fixed fee component. If that dollar amount exceeds $225,000, then you have to make some management decisions. So it's either I'm not going to have a certain type of indirect cost. I'm not going to use a consultant, instead I'll use an employee. I'm not going to use an employee, instead I'm going to use a consultant. So you start to make some business decisions at the proposal stage that help get you ready for the actual negotiation when you get notification that an award is pending and it's ready for negotiation. Now, every agency varies. They have their own little nuances. The federal acquisition regulations govern primarily most of government contracting, but then the agencies have their own nuances. So they have guidebooks. Defense has the DFARS. And so those little nuances are things that you'll tweak in order to fulfill the requirements of that respective agency. But for the most part, it's very, very similar math. Some agencies have safe harbor rates or safe rates. Some agencies don't. But you may end up with a fixed price contract, so in that case, it really doesn't matter. We'll go into a lot of that. But the key here is really acting like a business right from the outset and make management decisions to bring your budget in line with the amount of money that you're allowed to spend on that respective program, whatever that's going to be. This is not the norm. The backward approach is the norm. And all the companies that we talk, not all, most of the companies that we talk to, they will talk about more of this backward approach, which we see on the internet as being one of the recommended strategies. But the companies that tend to follow, knowing what your costs are, just having a more positive negotiation process. It's just less bumpy. So the fixed fee is the part that we say always go after the maximum profit, this quote unquote profit that you can get, because this is your most flexible dollar amount you're going to have. You can do whatever you want with your fixed fee or profit, so it's the same thing. And most agencies allow 7% as the maximum. You technically are supposed to support that 7%, so you can develop a rationale for that. And then once you support that, that gives you the cleanest opportunity to use those funds for any purpose whatsoever without any restriction. And some companies will put in 0%, 1%, 2%, and those are missed opportunities. So if you're looking at one thing you should look at, if a fee is allowed, go for the maximum fee that you can support up to the program limitations. And 7% seems to be the norm. Other agencies we see in DARPA, for example, it's 5%. Whether or not that's their maximum, I don't know the answer to that, but that seems to be something they push for. Other agencies, 7% seems to work okay. So indirect rate structure, these come in all different shapes and sizes. So if you think about the agency, how many of you have actually done proposals so far? All right, and what agency?
For schools and nonprofits and
Okay.
some of the things, I just kind of.
So you don't deal with fee at all. So that works it easy, right? How about you?
I did it for the USDA SBIR.
Okay, so you did what type of rate structure? Do you remember? Did you do like an overhead and G&A? Sound familiar?
If I can recall.
That's typical for them.
Overhead, and I took advantage of the rate
Yes.
as well because I had help with that, and I said, yeah, put the max.
You got
7%.
That's right.
It's like, oh, okay.
That's right.
I thought that would have been the overhead, but no, I didn't.
No, that's the cushion. That's
right.
the just in case there's an oops somewhere else in your proposal. Exactly. And who else had their hand up in the? Saw their hand up. Did you?
Yeah, it was just an SBIR with 7% on top of the
What was the agency?
numerous.
Okay. All right.
But all the IDs.
Okay, so the agencies in general, there's really two groups of agencies, and they just, again, with the companies that we dealt with, we see that with the DoD side, you're going to deal with an overhead and a G&A rate for the most part. That's a typical structure for them. They're used to seeing that. When you start to go into other types of rate structures, they really don't care in a phase one. They're just, they're indifferent on it. Phase two, as you start to go to the next level, they get a little more used to overhead and G&A. Your company, if you're looking at going commercial, which technically is the goal of SBIRs, is that you're going to use an overhead and G&A rate in the commercial world. So that is the more traditional, generally accepted accounting principle practice that goes on, is that you use an overhead and G&A rate. Usually fringe is not considered an indirect rate for commercial purposes. But with that being said, NIH tends to have a fringe rate and an F&A, facilities and administration rate, or they will just have a combined facilities and administration rate. So they, in effect, combine everything into one or two smaller rate structures. NSF looks a lot like NIH. They'll allow for a fringe component, and then they will also give you an F&A, which they just call an indirect rate. DOE will go fringe and F&A, but they also do overhead and G&A. So this is energy. They will tend to do a little bit of both. Yes?
How crazy do they get with this stuff? I mean, is it just, can you just...
It's less about them.
Overhead, or is it going to be, show me your overhead, or is it overhead?
Yeah, so it depends on the agency. So if you're doing a safe rate, a safe harbor rate, so NIH, we have a 40% rate, NSF, you have a 50% of salaries and wage rate, they're not going to scrutinize anything there. However, if you're doing defense, even though they might give you something fixed price, if you're doing USDA, they're going to make DOE, energy, NIH, they're going to make you justify what are the rates you're putting into your proposal. So why is your overhead 63%, your G&A 15%? So at that point in the negotiation stage, they'll button that up, and then they'll either issue a reimbursable grant, or they'll give you a fixed price grant. But you want to know all the answers ahead of time, so you're not backpedaling when you get the notification that an award's pending, that you now have to figure out where did that 63% come from. And we see that a lot, and a lot of that's because of the backing in of numbers, right, to make that work. So making your indirect rate structure just makes sense with your business going forward, not just for the purposes of the award, but going forward for your business, so you don't have to clean anything up later on. So if you're coming in with a new company or a pretty new company, you're getting your first awards, you want to have a rate structure that makes sense for your company going commercial. You're already thinking commercially at that point in time, because the agencies are very accommodating to your rate structure. You just have to let them know what it is. So rather than just accepting what's on the templates that are online, go ahead and go through the exercise of what rate structure makes the most sense. And I always recommend an overhead and G&A structure. If you're working with defense, you're going to use that anyway, but that tends to be the one that works better on the commercial side. As you're also looking at your costs, make sure that you have things in there on the indirect side that are related to indirect labor. So, for example, if you were putting your time on your timesheet, which you are required to put all of your time on your timesheet, whether paid or unpaid, that us having this session tonight would be considered indirect. So that's administration time, and that would receive its own allocation into your indirect cost structure. Thinking about benefits, phase ones, you don't have a lot of benefits. So you might have workers' compensation and payroll tax expense. You might have a little bit of PTO, but you're not having medical, you're not having full-blown dental. Some companies do. because they have a lot of phase ones. But if you're a single phase one company, you're not going to be spending a lot of money in that. So you don't want to have a 62% fringe rate when your benefits are going to cost you somewhere around 10% in a model of no medical, no dental, no 401k, and so forth. So just understanding what are the benefits I'm offering, what's realistic, and especially if you only have a single phase one. Facilities, do I need specific facilities? So in the very beginning, you may not need anything. You could be working out of your, you could work out of home to do your research. You could have small rented office space. When you start getting into lab space, and that usually happens at phase two, that's where it gets very, very expensive. So it might be a small facility cost in the beginning, know what it is, and then as you advance into phase two, then you ramp that part up. And then obviously professional fees. You're going to be paying lawyers and accountants to have some type of engagement with you in the earlier phases. So these are the 4 components that really help drive your indirect cost structure, and just fleshing those things out into what's realistic. And this is where you're making some of your management decisions to get your indirect rate down in order to fit your budget. A lot of companies they really don't do anything with indirect labor. They'll leave it out. They might just put in a fringe rate of 25%, although they're never going to use that fringe rate. And so if you have a reimbursable contract and you have a 25% fringe rate and your actual is 10%, you only get 10%. The other 15% is left on the table, unless you have a rebudgeting opportunity and a need for it. Facilities tends to be, this is a very hot area because sometimes companies will overstate the facility side in their budget, get the award, and then realize we don't need that space. So now they may be able to redirect that or have agency approval in order to use that money for direct purposes. Or they might use it for other indirect purposes to the extent they need it, since that's been the allotment. But knowing what the real narrative is. And that just means getting a head start on your proposal as opposed to it being more last minute. So when you're building up your contract, your direct costs, so these are just some areas that when you look at the proposal, and most of you, I'm assuming, have seen what a proposal looks like. The agencies have online templates. You're entering the data into these templates. And the question is, how do I justify? So the next slide or two is really about how you're justifying the various elements of your proposal. So on the direct cost side, there is a lot of substantiation that is required. So you're looking at the people who are working, who are my employees, who are my consultants, who are my subs when subs are applicable. It's very important to make the delineation between consultant and employee. And what happens is we see this becoming interchangeable as awards come through. And the problem with that is how you recover your indirect rates is based on the nature of the cost that you have incurred, the direct cost you've incurred. So for example, W-2 employees get fringe and get overhead. They recover that. So you get those indirect costs every time you generate direct labor. A direct consultant does not get fringe and does not get overhead. They might get general and administration. They might get facilities and administration, depending on the agency. So knowing whether I'm going to have employees or if I'm going to have consultants, you want to know that in the beginning. That's a little more difficult to change later on. Subcontractors are going to be a little different. So it's a matter of how many hours do I need each employee for, what would be their pay rate based on their education, their experience. It could be market conditions, whatever it costs to get individuals. There has to be a degree of reasonableness to it. And you're justifying that obviously in the budget justification with CVs. But in the dollar amount, it really is units times rate. So it's hours times the hourly rate based on an annual work year and how many hours they're going to work. So they could be full-time, part-time, and then the PI has to meet the labor requirements. You're going to have direct materials. Direct materials require some type of quote, proof of the materials that you need for the specific project. They fit within the scope, and you're using this vendor, this part, this quantity, this unit price, and this extended total price. And you're justifying all of that in your proposal. So obviously these things change by the time you get to your award because months have passed, but you always want to be in a position of tweaking your budget later on as opposed to redoing your budget once an award starts to come your way. Subcontractors, very tricky. So a lot of this is with universities, and you'll get proposals, but sometimes the scope is not cleanly fleshed out, and the university is not quite sure where the project is going, or you're not quite sure where the project is going. So they'll give you a quote of some sort, and they just need their total cost and their indirects broken out, because universities usually have a negotiated indirect rate. And so you'll break those two pieces out: budget justification. You need a quote, the scope, and then if you need to rebudget some of these items, you'll rebudget as you're getting the award during negotiations or afterwards if the agency allows you the chance to rebudget. You have direct consult. Oh, that's next slide. Okay, sorry about that. Direct consultants is your next category, and these are non-employees, and these are experts that charge you based on hourly rate plus other incidental expenses. Their hourly rates are loaded. That means they have their own indirects built in. You have to do some level of reasonableness on whether or not that hourly rate makes sense, because the government has to always get the best price. And it's also based on expertise. So the same qualifications for why is it that an employee makes X amount of dollars, you're following the same rationale with consultants. And as long as you're meeting the labor requirements, the amount of hours has to be done by the company, then you'll be fine with this. They are giving you invoices at the end of each cycle. So they're not giving you timesheets. They don't look like employees. If they start to look like an employee, then you have a whole different issue. And our recommendation is if it's remotely close to looking like an employee, and they don't look like they're in the business of whatever it is they're doing for you, make them an employee. Because that's a whole labor law issue. It has nothing to do with government contractor, but you don't want to get into the middle of whether or not somebody is an employee or a consultant. Direct equipment, you're not going to see that in a phase one often. We don't see it that often just because of the dollar amount. Some agencies don't even let you do it. So I would, this would follow direct materials, the same logic of getting quotes out there. How many of these do I need? What's the purpose of it? Justifying best price. And then direct travel, this is in a phase one, would normally be as required by the government. So NSF, for example, requires a kickoff meeting. That would be direct travel because it's required by the government to do this. Other agencies, some will put a couple $1,000s in there because they might be traveling to recruit an employee. They might be traveling to overlook or manage a subcontractor. And there might be some direct purpose in doing that, but you don't see a lot in direct travel. And other direct costs are things that are direct that aren't in the other categories I just said. So this is the catcher's mitt of the costs that are incurred directly to carry out the scope of the award. It's not in support of the award. It's to physically carry out the scope of the award. Bless you. So bringing it all together, every branch has their own little application, and I think it has somewhere, yeah, only use what you need. So the challenge with these online forms, and those of you who have done this can appreciate it, is there's a lot of lines to fill. And depending on the agency, there's a lot of tabs, a lot of sheets to fill. And in the end, there's this need, and we see this a lot. There's a need to fill in every single box, and you don't have to. You fill in only what you need to fill in to keep your life as simple as possible. And especially on the indirect rate side. The indirect rate side will actually have things that are like fringe, material and handling, labor overhead, G&A, F&A, so whatever else they have on there. And we see applicants put in a dollar amount in every box. And those rate structures overlap. They're inherently similar. Various combinations of each leads to another type of rate. So what happens is when the award comes in, you have multiple rate structures you're tracking, and to clean it up later just becomes a very challenging exercise. So save it in the first place and go with a simple rate structure in the beginning. Provide adequate narrative. This is always a good thing. So not that if you put certain things in your proposal, they become binding. It is you're letting the government know this was our intent when we had a certain type of cost included in our proposal. So there's no surprises. And in the end, if there's something that becomes questionable, at least you have something to refer to. Leaving things out there means that when you get audited, you will be in a what I call a default position. Default meaning that you will fall into the default of how people would treat certain costs. So therefore, we have some companies where they'll have rent. And because they have one grant, they're calling the rent direct. Rent inherently is an indirect cost. So if they don't put rent into their proposal as a direct cost, and it's silent, then the assumption by an auditor would be rent is indirect. So there's areas where it goes gray. You want to make sure you control more of that process than have it controlled for you. And that becomes the budget narrative. And that's the important part. Stay within any limitations. So if it's $225,000, that's the limit. You can't do $225,001 because those are natural disqualifiers. If you have to have certain labor coverage, make sure you meet the labor coverage, the subcontractor rules, SBIR, the PR, employment rules. Just make sure all of that is in play. Reflect reality so you're ready to negotiate. I can't tell you how many times, it's got to be at least a third of the companies that we work with, it's last minute. It's, oh my God, I got this thing going on and I have to justify my budget. And so, of course, my question is, so where do the numbers come from in the first place? And we know the answer, backwards approach. But now we have to justify these. And once you're awarded, you're within what's allowed as a limitation from the agency. So the goal is just know the reality in the first place. Know where the areas are you're going to look up later on. You don't have to revisit those areas until you know you're getting the award. But in the meantime, know you're pretty darn, like you're 75, 80% there. And again, that's just allowing yourself more time. Act like you're getting the phase 2. So if you're acting like a phase 2 in a phase 1 setting, the good news about that is you're ready to go for a phase 2. You have operating systems in place. You have a culture, might be one full-timer and a part-timer, whatever it is. You're establishing a company culture of we're doing certain things certain ways, and timekeeping is one of the biggest ones, is making sure that you're complying with the timekeeping side. And really bringing what the government, it's really best practices. Acting with the federal government is just elaborate job costing, best practices for commercial companies. So as your company goes commercial, then you know how much things cost to build. You know what you should be charging based on some market research. You know if you're making profit on the product. Those are nice things you can tell investors. So you have all the pieces in place already to start that process. And the best time to do is when you first start. And then these are the benefits downstream. I keep forgetting that one part. So that being said, questions? Was it like 30 minutes now? Jeez, that's crazy. I'm getting this thing down to less and less. That's not the goal, by the way. That was me talking more slowly. Yes, go ahead.
I came in a few minutes late, so I didn't know. I apologize if you said this, but what are the odds of being audited at even at a phase 1?
A phase 1 would be rare. If I don't think we've ever had one. Like an after the fact audit, never had one.
And a phase 2?
Phase 2, it depends on the agency. So DoD, you will always go through some type of audit or low risk review of your indirect rates, your incurred cost structure. You'll always have an audit. Any company with more than $750,000 with DOE, NIH, and I believe NSF follows the cognizant agency, you'll have a compliance audit. So that will happen, and it's less about the financial statements and it's less about incurred costs. It's more about processes. So the compliance audit looks a lot different. The audit is a schedule of what did I spend per award, so that gets audited, but then your entire system gets audited. So how do you bill money to the government? How do you draw money down? How do you manage your government-funded equipment? How do you handle subrecipient monitoring? How do you handle debarment? So debarred vendors. How do you know you're working with eligible employees? So there's a procurement. There's a lot of different little elements that are more compliance and less financial in nature, and that would go through anybody who has a compliance audit under the that is Energy, Health and Human Services, NIH, and NSF.
It's really important to have an accountant phase 2.
Yeah, so if you're looking at a process, it makes sense. When you look at a phase 1, you just want to make sure that you're starting off with a, we'll call it more of an accounting system like, because you're not looking at indirect rate management or anything like that, unless you have a reimbursable award. So those of you who work with DoD, your phase 1s are always going to be, what we see is always going to be fixed price. So your after the fact reporting, there really isn't any from an accounting standpoint. But if you're working with NIH and you're working with the Department of Energy, you're not going to be fixed price. You'll be reimbursable. Then you're going to have to justify your cost. And you do that through a final submission to those agencies to let them know this is what we actually spent versus this is what we thought we were going to spend and what we had billed the government. So they're a little different in those areas. NSF tends to be fixed price in nature of phase 1, and they seem mostly fixed price now in SBIR phase 2s. It used to be a little bit of a hybrid, but now we're seeing mostly fixed price in that case. Yes, sir.
With that business of after the event, saying this is what we spent. Does one have to get down to the different categories that one initially budgeted and say, all right, well, that was $100,000 that we budgeted there, but we spent 60,000, and this one was 50,000, but we spent 80,000. Do they need it at that sort of level, or are they just looking at the gross?
Just looking at, so you're talking about closeouts. So if I look at the closeouts, NIH is going to look at total cost, total F&A, and that's your closeout. So they're not looking at line by line. They're trusting that you're meeting their rebudgeting guidelines of, was it 25%? NSF will, it all depends on the program. We see companies submitting budget versus actuals at the end. That's typically in a phase 1 to a phase 2, but we do see it. And that one there, but it's not where NSF comes back and says, oh, you're supposed to spend $12 on nuts and bolts, you spent 38. So I don't see that with NSF. Defense allows you to recover on reimbursable awards all allowable costs associated with that award up to the award. So if they gave you a budget of whatever amount of dollars to be reimbursed, they don't look line by line. But they do look at things like how many hours were expended. It depends on the program. Programs, the branches, they're all a little different. But they may ask for other little cross-check types of things that make sure that the effort of labor is really in there. Energy will look at theirs, the SF425, the final closeout for them. That is a total disbursements. That's lumped together, although the indirects are broken down later in the form, in that submission. So they care about what were your actual direct cost bases, and then what are your actual indirect costs based on the cost structure you chose. Does that total disbursement equal or exceed the amount of money you billed us? And then if there's a negative, then you owe money back. So it's not common you would see the line-by-line budget now that I've gone with the major agencies. But with energy, you'd have to stay within their parameters, and they're not as flexible as 25. I think they're 10, or it's a different percentage. Where you have to get approval to shift between budget lines. But the programs are different. SBIRs are different than RBEs, and there's different programs handled different ways. The core accounting system is pretty much the same between all those, regardless of the contract type. Yes?
George, since I know it comes up quite a bit with the people we work with, can you dive a little bit into what is actually DCA compliance and the kind of two different areas of DCA compliance, one for your actual operational policies and procedures, and then for your kind of financial accounting, chart of accounts, and so forth?
Yeah, so DCA has a pre-award survey. They have you complete what's called SF 1408, and that form has everything that makes an adequate accounting system. And then you're documenting, yes, I do meet this, yes, I do meet this, and then they ask you afterwards, give some example of how you're meeting the requirement. So when you're about to get an award with DoD, that's going to be a CPFF, a cost plus fixed fee, a reimbursable award. You will have a pre-award survey. That is pretty much guaranteed. And so what they look at there is they look at your chart of accounts, timekeeping, whether or not your job cost system, A, you have a job cost system, B, the job cost system can handle multiple contracts, multiple lines on a single contract or tasks, that there's some budget limitations, you can meet the contract limitations, that you have a clear delineation of unallowable costs, and that's in your chart of account structure, that you have your indirect cost pools, fringe costs, overhead costs, G&A costs, can be accumulated in the general ledger, so it's in the accounting system, so that's a numerator. The denominators can also be accumulated in the general ledger of the books, and then those two numbers, when you solve that, becomes the indirect rate, depending on what indirect rate structures you selected. Your books and records are audited to see whether or not they can actually accumulate numbers to do those calculations. That's the beginning before you get an award. Then you go and invoice the government, and they're going to say, you have a rate of 60% overhead and 15% G&A. Did you do a proposed billing rate for us? It's called PBR. And most awardees have not done that. So you have to attach that to your first or second billing, maybe get an email confirmation. DCAA they get to them pretty quickly. They'll usually give you a very quick email, yes, for now. And then they'll take a look at it, then they'll issue a letter. So now that gets you through the billing cycle of uploading things on the workflow. And then at the end of all of that, so December 31st closes out most of your fiscal years, I'm assuming. And June 30th of the following year, you have to submit an incurred cost submission, and that's a true up. So what did you bill us versus what should you have billed us, and what is the difference on a cumulative basis? And then you have the obligation of adjusting your billing in either of the two directions. We overbilled you, we underbilled you. Let's do a corrective voucher billing to the government, netting that together, and then look at a new projection for the next year. So that gets you through the DoD cycle, and then when that incurred cost submission is audited or accepted as is as a low risk auditee, then at that point that year is closed. So there's a lot of compliance on the DoD side because they don't have anything around safe rates. And they'll usually work in NASA, Homeland Security, that will usually fall under DCAA. So the good news is you're constantly monitored. The bad news is you're constantly monitored. So you actually get it both ways, and it does help the organization stay in line just because of the frequency of the amount of effort that DCAA puts into it. When you look at an NSF award, you're going to fill out a financial questionnaire, which looks like the SF 1408. So it's going to ask the same types of questions, going to ask you for some examples, and then they'll ask you for what does a timesheet look like, what does a job cost ledger look like. So they're testing little pieces inside the system, and then they might be okay with what you represented as being adequate. If there's gaps in there, they're going to take a look at the gaps. They may or may not take a closer look. Years ago, they actually would review your accounting system in more detail, like DCAA did. But lately, we haven't seen that. NIH, you do a questionnaire. Excuse me. And they look a lot like NSF. And DOA will look a little bit like DOD. So there's a big process. If you're looking at what would be good practices for a phase one, if you're applying for a phase one, your first time applicant, just know how to build a budget. Know my directs, know my indirects, know my fee, and get that part done and make sure that's as real as it possibly could be. As you're getting your phase one award, you want to put in an accounting system at that point. You can run it yourself. Do the accounting system so then you can demonstrate that we have most of the pieces of an adequate accounting system in the event we get a phase two. And then when you get to phase two, you're strengthening the accounting system. You might be adding an accounting manual that's documenting all of your step-by-step procedures. And then that manual becomes what the government will audit when they look at your accounting system. The manual says, here's how we do everything. The accounting system says, here's the evidence of how we do it, because DCAA is going to say to you, show me. They're always going to tell you to show me. If your system says this, or your practice says this, or whatever it is, they're going to say, okay, show me. And there's times literally I've had auditors looking over my shoulder as I'm in a QuickBooks data file snapping pictures of how it works. And so they do follow whatever it is you say your system does. They say, is what you're saying okay with us? And if so, show us that that works. And then they're fine with that. These pre-awards they're tedious only because if you're starting out from scratch at that point in time, it's very, very time consuming, especially if you have garbage data. Once you have bad data, the data's got to be cleaned up. And when you have no data, it's nice and easy. Just get a chart of accounts and a turnkey accounting system, you're off and running. So does that help?
Yes.
Okay. Other questions? Yes.
You said a little bit about how important the budget narrative is to be your friend. Did you also say it's important and that it shows intention? Did you say that we should put like a little sentence or two in there that says this is the intention, so it gives us wiggle room? Did I hear that right?
No, because you're going to have, if you have anything that will be different than the normalcy of a cost. There's direct costs and indirect costs. We can look at them and say, oh, that's indirect. That's right. We just know the nature of a cost. I meant to say the word nature. It's the nature of a cost. If you have anything that's going to be a little gray, but you want to treat it a certain way, that's where you want to put it into the proposal just to let them know and make it part of your direct cost budget. Now, is that legally binding? The answer is most likely no. But what it does do is it just puts everybody on notice. This is what we always intended to do, and this is what we did. If it's silent, it's pretty much black and white that that cost is going to be an indirect, because of the normal nature of that cost would be an indirect. So that's really the only thing that you're looking at there. And the thing that we see is usually some type of, I rented specific lab space solely to work on this contract or this grant, and therefore I made that a direct cost because I wouldn't use it for any other purpose. So that comes up from time to time. There are times where awardees will put in office supplies. You don't want to put those in there because they will usually move those out. So they'll give you pushback. If you're doing, the classic is laptops. I want to buy a laptop, on the award. Well, the government owns it. So what? Don't. Just make that part of your indirect so you have total flexibility, because anything you buy under the grant, the government owns until they dispose it to you. They say you can have it at the end, or they tell you to do something else with it. So that's just keeping it simple and not getting too much into the weeds on these things. I've seen some really elaborate proposals where it took so much time to do the budget that they would have spent half the time just doing the budget right. It was just so much stuff, because what happens is people talk, and you have mentors usually the mentors at universities. This is usually where it comes from. And they have their own little, I'll call them tricks of the trade. Well, we've worked with a lot of companies over the years. And I don't believe there are these tricks of the trade. I just don't. I don't believe that, when we look at audit experience, the government's not out to get awardees. They're out to make sure that everything worked the way it was supposed to, and everything that was certified is legitimate, and that's a good thing. That's fine. The government likes things to be nice and simple, but that's how you want it in business anyway. You don't want anything that's too complicated. You want consistency, and the government likes consistency. The types of indirect rates you select. So some companies will drive down their indirect rate and put everything into the direct. Now some agencies will let you do that. They'll give you some flexibility in a phase 1 setting. But we never recommend that, because that's a one-time thing. You're not going to do that with a second award, because once you have 2 awards, you don't have a direct cost anymore, because now it's spread over 2 awards, so it's not directly attributed to the scope of that one job. So by nature, it's becoming more indirect. So why put yourself in that position in the first place? So trying to manage these things. When we get awards that have no indirect costs, nothing. And once you get that award in the phase 1, you're not getting any indirect costs. They're going to say, oh, you put a 0, thank you. And that's pretty much it. That process is done. But they'll put a 7% fixed fee, and you go, wow, you got something. Some will put in a 50% fringe rate on NSF and nothing for an indirect rate. Now, these things become fixed price in nature, but the reality is you're never going to incur a 50% fringe in a phase 1. It's just not going to happen. So if anything, you put nothing for fringe in NSF and take all of your indirects and your F&As. You have greater flexibility. The goal is to have flexibility in managing your awards. And the government wants you to have that flexibility. They want to make sure, has anyone done NSF awards at all? So NSF, when you do their awards, they do a financial capability analysis. They want to make sure you're doing okay before we give you money. And so they just want to, they don't like seeing proposals written up that way. But some companies are funded, and they'll say, we're going to pay our own indirect costs, and they're okay with that. So, other questions? Yes?
These assets that belong to the government, do we need to label them?
They have dollar thresholds. There seems to be a $5,000 dollar threshold depending on the agency. But the answer is you're supposed to account for all federally funded equipment.
Right.
Yeah.
Actual labels.
They would love to see a sticker with a 6 to 12 digit number. Just so, I don't know if it's 6 to 12 digit, but something. Yeah. They would like to see a log.
Oh, the logs there.
And then they walk over across the room. They go, that's it right here. And then they see a sticker on the back, property of or tag number or whatever. Yes.
The government does then assign the property to us at the end of the project. What's the GRT implications? Are there
The what implications?
GRT? Gross receipts tax?
There wouldn't be any taxable implications, because if you bought, so let's say you bought a piece of equipment for $10,000, you would have expensed that $10,000 and picked up $10,000 of revenue. at the point in time that you bought that equipment. So I don't see a tax implication. There's no book value. Other questions?
So is there a magic number of your indirect direct cost ratio?
So that's one of those things, those little tricks of the trade. I don't see it. I have companies that will have, let's say, if you were in the NIH world, they'll have a 40% safe rate or 92%. That's a big rate. I have overhead, fringe and overhead and G&A rates in companies where overhead could be 45%. I'm sorry, fringe could be 45%, overhead could be 150%, G&A could be 15%. The logic is on this thing called a multiplier. So if you look at what is $1 of labor cost the government when you add all the indirects and add the profit to it, if it's $2 of cost to the government per $1 spent, you're at a reasonably priced contract. Then there's a 2.3 to a 2.6, a 2.7 to a 3.0. I have never seen any evidence of that, but I don't work with competitive awards. If you have competitive awards, it could be a whole different world. But if you're in the SBIR world, I've never seen it in the 17 years I've been doing this. Never. So we try to work with companies to make sure they're reasonable. So if you put two things side by side, they're competitive. But if it's not a competitive environment, then it's what you can justify. If it's competitive, obviously it's a whole different thing. We work with a lot of awards. That doesn't mean you don't try to keep your costs as attractive as possible. Other questions? Yes.
It seems like there's a lot of tricks to know with the application process itself. Is this something that your firm helps with at all?
No, we work primarily on the cost side. So we're going to be all about the budget and so it could be budget buildup and then anything related to the accounting system and reporting thereafter. Anything on the technical side, the applicants, and that's the purpose of a lot of these conferences and trade shows, is the applicants are developing the relationships with the programs directly, and that's going to be the closest relationship. There's nothing that an accounting firm where we would be involved in the technical or scientific part of what a government agency needs in relation to them and the scientists.
In terms of establishing budgets?
That's the part we can help in, is that you'll see it one way and then we would just provide some assistance in whether or not that's the best structure for this. And if you can manage your budget down to hit the parameters and keep your direct side meeting the scope, that's your ideal world, then those are the types of things that we would highlight. We always look at indirect rates, for example, and then say, why are you looking for 40%? Maybe you only need 35% or 32% if it makes your directs work. The trick there, though, is when you go for a safe rate or a safe harbor rate, that once you have that safe harbor rate locked in, even though it's below the 40% that NIH allows you, let's say you did 32%, you're not getting more than 32%. So some companies will manage to the 40% too. And that just, again, all this is to provide you the best flexibility. Because what happens when you get an award is that one of the first things we do is what we see organizations will go out and they might rent space and then they might buy a computer and then they'll, have lunch, and I'm just throwing all these indirect things out there, right? The celebratory lunch. And then they burn through $5,000. And so let's say you work with NIH. You can't draw the $5,000 down because you didn't do anything direct. So you got to take your direct plus your 40%, and then does that provide you enough for the $5,000? So you always want to do your direct activities first, and then you're able to get more indirect to help fund your operations on the indirect side up to your whatever your rates are. So, but that's all part of the planning process and helping once you get an award. We usually see the opposite, and I get it. Or sometimes we're afraid that something's not going to go the way we think it is, so we slowly ramp up our labor. Then we find out we didn't do the work fast enough, so we have to have an extension. And then does an extension impact a phase 2 application? Not the application itself, but the award. So those are all things that are all fixable and plannable as you get your award and how you ramp up. Other questions? Yes.
Is there a preference between employees and consultants in stage 1 and stage 2 that you've seen?
It's mostly employees. So we do see mostly employees, and I think there's an awareness now of people staying away from the gray area of a consultant, contractor versus an employee. But there are specific companies that might have a specific culture of doing consultants versus employees. That's not our norm. The norm is employees, and we always advise, if, like I said earlier, if it's gray, it's going to be an employee. I mean, you don't want to be in that part, because think about it, your employees, you have to make the determination right, because when you do your timekeeping, all of your time is required to be reported, whether paid or unpaid. And the last thing you need is a consultant being reclassified as an employee who worked a 90-hour week, and now you owe 50 hours of overtime that you couldn't even imagine. So the risk is too high in order to not have someone classified as an employee. Now, with that being said, there are cases where if someone's working 2 hours every 6 weeks, they may not be an employee. So you got to look at the individuals and the nature of what they're providing, and are they protected by the Federal Labor Standards Act? Are they in the right bucket when you classify them as exempt versus non-exempt from overtime? So, and those are all DOL. Those are all labor issues. But that's what you're keeping in the back of your mind in budget formulation, because you're a business first, and you want to do business with the federal government. Well,
just to follow up on that, depending on the agency, there's a limit to how much contracting work you can
that's right. That's right. Yeah, they'll usually have something about a majority. They'll say majority of the labor has to be expended internally. Some will count consulting, some won't. And that's right. And it depends on the agency themselves. And I think across the board there are some limitations to all of them.
Yeah. Yeah, sure.
Other questions? All right. Well, I think we're done. Okay, thank you.
Thank you.
Well, thank you.
All right. So if anybody else has anything more one-on-one, I'll be around. Of course, Dell.
Everyone who signed in, I'll be sending out a copy of the slideshow. So if you guys want to review, or if you want to set up an appointment, George, to talk about budgets or phase 1 applications, that type of thing, feel free to send me an email, and I can get those on the calendar. All right.
All right,
I also have a bunch of pens and little phone things if you guys want some merch.
Merch. Calls it merch.
Of course.
I don't know what the next step is. I'm lost. Lost our leader.
Yeah. Digesting it all.
All right. So
That's gonna lost our leader.
That's going to finish up the workshop. If you do have any other questions, you want to talk to George real fast, we definitely have time. We actually have this room until 6 p.m., so another 35 minutes. As I mentioned at the start, we are doing an informal networking event over at Dialogue Brewing. That's going to kick off at 6:30. It's going to be program managers again from Navy, Air Force, and NASA there that you can talk to. Also other panelists. Some of the other panelists that are for our event tomorrow are actually going to be from support organizations that can help you grow, help you get to that next stage, like the New Mexico Economic Development Department, other programs from Arrowhead Center that provide more of that foundational business assistance. Because what we do with FAST is we help you go after SBIR packages, and that's kind of all we do, because that's what we're contracted with the SBA to do. However, Arrowhead Center does have a lot of programs. They have programs that can help you find technical assistance. They have programs that can actually do some small scale prototyping for you, some rapid development. We have programs that actually do help you do customer discovery, customer identification, market surveys. Anything you need to do as a business to take your idea to the next level, to take your innovation further along the commercialization pipeline, whatever you need for business assistance, Arrowhead Center does in some capacity. I have cards. I'll make sure to hand out a card to everybody. But again, thank you for joining us. if you want more information about the different programs that Arrowhead does and more information about kind of what we do, why we do these, what is our goal in going forward, just as a whole, feel free to, ask me. We're going to stick around for a while. Otherwise, I hope to see you at the networking event. And if you have not done it yet, please fill out the survey. It is two-sided. Just as a heads up, a lot of people will forget that one. But thank you again, and we will see you.